All right, so the next chapter deals with corporations. Now corporations, now this is going to be different, right? Because what we're doing here in corporation is you actually create a being, right? So it's created by law. It's created in a lawyer's office, okay? And it's created in a lawyer's office without a soul and it won't die. Okay? All right, now, okay. Now, some of the advantages are, it's a separate legal entity, okay? So it's a separate legal entity. And essentially what this means is the fact that when you form a corporation, you actually create a being. And this being, of course, you can own the corporation and the corporation can hire you. So you're both an employee and an owner. Now this makes a labor dispute kind of tough, okay? It has limited liability for the stockholders, okay? For the stockholders, the owners. So they have limited liability. They also have transferable rights, okay? And they can sell their share. They can sell their ownership. It has continuous life. So with a partnership, if there's two of you in a partnership and one passes on, the partnership's over. But if two of you in a corporation and both of you die, the corporation still continues to exist. There's a lack of mutual agency, and that's seen as an advantage. You don't have to worry about your fellow stockholders, G and CY agency. You don't have to worry about your fellow stockholders making an heir that you have to live with. And of course, it has ease of capital formation. And of course, what that means is the fact that if you're a sole proprietor, you're limited to just the amount of money you can invest or borrow. A partnership, you're limited to you and your partners. But with a corporation, you can sell lots of stock. So you can raise more capital more easily. Some of the disadvantages are, it has a lot of government regulations. Okay. And I'll put GOVT for government regulations. Okay. And of course it has the corporate tax. So government regulation and corporate tax, it has a lot of government, it has, so you have to, if you incorporate, you have to spend a few $100s every year to pay your accountant, to file all the taxes for it. It's not like you can fill out your own 1040 sort of thing. Okay. And of course, the way this works is the stockholders, they're the owners, right? What they do is they elect the board of directors. Who, of course, hire the president. And the president hires the officers. And of course, we're considered the secretary, the vice president, that sort of thing. And then, of course, they run the organization. Okay. Now, so don't forget. Let's take a look at the idea of par value. Okay. So par value is not market value. Okay, so par value is, well, let's start with market value. That's what somebody will pay for it. So, and again, the market value is whatever anybody will pay for it. Okay, that's all. That's what the market value is. They put it up for sale, somebody pays for it. The par value is a negotiated amount set aside to protect creditors.
Can you repeat that, please?
Sure, I mean, it's creditors. So it's a negotiated amount, and when it is, when you incorporate with the state. You negotiate with the state and say, let's establish a par value. So it's a dollar amount per share. So every time you sell a share of stock, so let's say it's par, it has a $2 par. Every time you sell a share of stock, $2 goes into the par account, it would be the common stock account, and that has to be kept in the business to protect the creditors, because don't forget, it's a there's limited liability. So with a limited liability, that means that if somebody sues, a lot of times they're limited for what's in the corporation, and so a certain amount has to be kept in the corporation, and that's called the par value. So you negotiate when you incorporate, and you agree to set a certain dollar amount every time you sell a share into the common stock account. That's where par is kept. That's where par is kept, so a certain dollar is, and then this has to be kept in the business, in the corporation, to protect the creditors. Okay, and that's what par is, yeah.
Is that required by law?
Yeah, it is. These are heavily governed by laws. What varies, of course, is the fact that if you have a service business that has few debts, etc., your par value is going to be small. Suppose you're like a manufacturer where you have that type of business has a lot of debt because they need, they need the buildings, the machinery, etc. They'll have a bigger par value because that type of business will have more creditors. So it's negotiated when you incorporate with the state, and you incorporate with the various states. So for instance, a lot of states have a favorable, like New Jersey has very favorable business laws. So a lot of people will do business in Washington, but they'll incorporate in New Jersey. And just because it's good to be incorporated in New Jersey, because they have very favorable incorporation laws. And a lot of people, okay. And then lately, a lot of people have been incorporating down in Nevada, so when they hold their shareholder meetings, they can have the party. Okay, yeah, all right. Okay, so the market value, again, what everybody will pay for it. The par value, it's a negotiated amount when you incorporate, and it's negotiated with the state, various kind of business, and you agree to set aside amount every time you sell a share, and that's kept in the business to protect the creditors, okay? Now, let's put up an example here. Now, in this particular example, you issue 100,000 shares, okay, $2 par, and you issue it for $25, okay? Each. So the $25 is the market, $2 is the par. Now, when you do that, what you do is 100,000 times $25. So we'll just make this September 1. Cash will be debited for $2,500,000. Then you have the common stock account. And the common stock, this is where you keep the par. So 2 times 100,000 is 200,000. That's where you keep the par, and the name for that is common stock. And then you have paid in capital, in excess of par, and that's an account name. So in this case, that will be $2,300,000. Okay? All right. So you issue 100,000 shares at $25 a piece, so cash is $2,500,000. $2 par, that meant 200,000 goes into the common stock account, And the common stock account is where par is kept, and you're restricted as to what you can do with this money, because the state, you want to keep it in the business to protect the creditors. The amount above par, which is $2,300,000, goes into paid in capital excess of par, and there's a lot less restrictions on what you can do with this money. Okay? Yeah.
Who sets the market value?
That's strict, that floats. The market value is
Does the
literally.
company?
No, what anybody's willing to pay for it is the market value. So here's the deal. You can have privately held corporations and publicly held corporations. If it's a privately held corporation, it's generally a small number of investors. Coors Brewery is privately held. When they have a stockholders meeting, everybody shows up in their short sleeves and they hold it in the kitchen of Adolph Coors, okay? If it's publicly traded, that means it's traded on the New York Stock Exchange and NASDAQ and that sort of thing. But again, and when I say this, that if you offer your stock, you say, this is what I think it's worth, somebody will say, this is what I'm willing to pay for it. What anybody's willing to pay for it is simply what it's worth.
Okay.
And so, it's a very psychological thing that you can because this you can estimate what you think is the underlying value of each share, right? Because you can take the value of the company divided by the number of shares. That's like its book value, right?
Yeah.
And it doesn't make any difference. That is its book value. Now that's a starting place for negotiating if you want to sell the business and things like that. But the market value is simply what anybody's going to pay for it,
Okay.
and nothing more. And so, and then, for instance, as an example of that, Amazon didn't make a profit for years, and yet their stock value stayed up for no reason. Their income statement was anemic. But people said, this is a darn good idea, we think you can pull it off, we're going to stick with you. And so their price stayed up, even though their earnings per share or whatever was dismal. And they did make it, and they made it good. And so, but again, it's just because people believed in them. And so, which was all psychological, because when you looked at their income statement, et cetera, they shouldn't have justified that to anything. Yeah.
What do you mean you say protect the creditors? What exactly does that mean?
Well, in this case, don't forget, it's there's limited liability with the corporation, right? So with limited liability in the corporation, that you can't get through to somebody's assets, okay? And because you can't get through to somebody's assets, the corporation has to have assets, so the creditors can attach something should things go bad.
Okay.
Yeah.
So if the corporation goes belly up.
If the
They
corporation
have
goes,
to
if the corporation goes belly up, then the creditors have this to attach to claim.
Okay.
Okay. In fact, this is tangential, but I think it'll also make the point. This is not directly answer your question, but I think it'll provide a better answer to it. If you have a small corporation, like a limited liability corporation and things like that, there's one or two of you in it, and you go to make a loan, they'll require one of you guys to co-sign. And the reason they do that is because the corporation has pretty few assets at that point in time. And they don't want to, it's too risky. But they'll ask one of the owners to co-sign, so the owner is then personally responsible. But that's that's another way of handling the same situation. Let's go back to the example we had here. And in this example, they have the one sale, right? And what they did, and I'm going to introduce some retained earnings at this point in time. So the way this works is, what they did is, let's say the balance sheet was published at this point in time. So what would the balance sheet look like? Well, here's the stockholders' equity section. And of course, you'll have common stock. Now, that's the account name. But here is all the detail that's normally included. This is where the detail is included, probably better way of saying it. It had $2 par. Okay. 500,000 shares have been issued. And outstanding. And I'll explain these things in a minute. Paid in capital in excess, and that will be 200,000. paid in capital in excess of par. That will be $2,300,000. Now, I'm going to put in retained earnings next. And I'll explain this in a minute. So retained earnings, and that is $650,000. Add all of that together, it comes to $3,150,000. And that is total stockholders' equity. Okay, that's total stockholders' equity. Now retained earnings. Now retained earnings is a permanent owner's equity account. Revenue and expenses are close to retained earnings, and drawing comes out of retained earnings. So when you close, this is a corporation, so here's closing. What you do, you got revenue, you got expense. So both of those are closed to retained earnings. And dividends come out of retained earnings. Okay? Now, by the way, you'll see where dividends come out of retained earnings. And by the way, a few other things change retained earnings, but this is the bulk of it. So retained earnings, which is right here, it represents profit that's been left in the business since its very beginning. Okay? And it's a permanent equity account, owner's equity account, and it represents profit that's been left in the business. Now, if you end up with a negative here, which can happen, then there's an accumulation of too many dividends and possibly a string of net losses that can result in a negative retained earnings. And of course that could, if it's big enough, could result, of course, in negative capital. Okay? All right. All right, is everybody doing good? All right, so let's get into dividends. So what dividends are, is they're a return, hopefully, it's a return of profit, okay? But, okay, so let's start, what I'll do is, just to make good use of the board, let me start here, okay? And so there's 3 important dates, okay? And one is the date of declaration. Another is the date of record. And another is date of payment. Okay? Now the date of declaration, first of all, what happens in this is the board of directors can declare or not declare a dividend at their discretion. Okay? Does that make sense? So the board declares dividend. Okay. And at that point in time, they record the liability. Okay? The date of record, who owns it on this date gets the dividend. And whoever owns it that day gets the dividend. And by the way, there's no journal entry here. And the date of payment is when it's paid. Cash to stockholders. Let's call, here we go. So what happens on this, January 19th, right?
No, I don't need it.
What they do is the board says every stockholder gets $1 per share.
I'm sorry, can I ask what this is that we're doing right now?
Well, what we're going to do is we're going to have an example of the journalizing that's involved in issuing a dividend.
Okay.
Okay? So on January 19th, $1 per share dividend declared. Okay?
Was this in June 19?
I'm sorry, what's that?
June 19?
And it's June 19th. And that would be the date of declaration.
So it's January.
Oh, January, it is January 19th. You said it's June, January, yeah. And it's just the date of declaration, okay? Dividend declared per share. And there's 100,000 shares outstanding. Okay?
10,000 shares?
10, I said 10,000, yeah, I meant 10,000, I said 1,000. 10,000 shares outstanding. Okay? All right. Now, 10,000 shares outstanding. It'll be paid on March 19th to stockholders of record on February 19th. Okay, so January 19th is the date of declaration, okay? Now, retained earnings are debited for $10,000. And it's 10,000 shares outstanding, $1 per share, 1 times 10,000 is 10,000. And you have common dividend payable. All right, PAY, 10,000. So this is the date of declaration, okay? And payable, it's a liability at that point in time. Then, on February 19th, okay, is the date of record. That means whoever owns it on the 19th will get the $1 per share, but there's no journal entry. The registrar will know who owns it on that date. And then, on March 19th, when they send the money, common dividends payable will be debited for the 10,000, and cash will be credited for the 10,000. Okay? Okay, so date of payment, date of record, or date of declaration, date of record, date of payment. This is a liability, and of course, this common stock, this common dividend, is that common dividend. Okay. All right. Sound good? Now, a couple things here. It says common because later on we'll get into preferred stock. That'll be a totally separate, different dividend. And, okay. All right. Let's